The government-sponsored programs limit how much they will contribute to your mortgage in order to entice them to modify your loan. That amount is based on percentages, so you'll want to do some basic arithmetic. If you didn't make it past the 5th grade, this is also known as the hard part. Get out your pay stubs and add up your gross income. The gross income is the amount before your taxes and other deductions are taken out. Take the total and then divide the total by the number of pay stubs you used. So if you added 5 pay stubs, divide the total by 5. That total is your average income per pay period. Now most people are paid every other week. That means that they're usually getting 2 paychecks a month, but in some months they get 3 paychecks because most months contain more than 28 days. Since there are 52 weeks in a year, you have 26 pay periods. So to find your monthly income, just multiply your average paycheck by 26, representing the number of pay periods in a year, and then divide it all by 12, representing the number of months in a year. If you're paid weekly, multiply your average paycheck by 52, representing the number of pay periods in a year, and then divide it by 12, representing the number of months in a year. If you're paid twice a month, such as on the 1st and the 15th, it's a whole lot easier. Your monthly average income is your average paycheck times 2. If your spouse has an income, calculate that income in the same way. If you receive income from rent, Social Security, child support, alimony, pension, or any other source, whether or not it is taxable. It could even be moonshine. Don't forget to include it. Now add all the monthly income numbers, your income, your spouse's income, and your income from other sources. Take that total amount and multiply it by 31%. If your computer has a percentage button, you just need to press that button to get the percentage. So you'd enter in your total income per month, then press X or star for multiplication, then enter 31 and then press the percentage button. But if your calculator doesn't have a percentage button, get this amount by entering the total monthly income, then press the X or the star button for multiplication, and then 0.31, and then press the enter button. Okay, so now you know what 31% of your income is. According to the government, this is the most you should be able to afford to pay for housing. Would you be happy if you could pay that amount? Your answer is probably heck. You might even be dancing. Even if you qualify for a government program, 31% may not be the payment amount you're offered. What a tease, huh? Well, the government programs now offered will only pay your mortgage company a measly 7% of your income. So in all likelihood, that's how much your mortgage company will lower your mortgage payment by. What's 7%? Get back to your trusty calculator. Enter in your total monthly income and multiply by 7%, which of course is 0.07. Subtract that amount from your current mortgage payment. Not very much money, huh? I've seen better deals at the swap meet, but that's the most that your mortgage company will get from the government to entice them to reduce your mortgage payment. Compare the calculation of 31% of your income to reducing your mortgage payment by 7%. There's probably a big difference between these two possible payments. Unless these amounts are fairly close, your mortgage company can turn you down for a mortgage modification. If 31% is a lot lower, you might be out of luck because they can say you don't have enough income to afford the property. If 31% is a lot higher, then they can say you make too much money to qualify for a loan modification. Welcome to the gotcha and the twisted logic of the banks. Now, let's consider loan modification from a completely different perspective. This method might be more persuasive in getting you into a loan modification that you can afford. Look at your mortgage statement to find out how much you pay each month for insurance and taxes. This could be called an escrow or an impound. An escrow or an impound is the portion of your mortgage payment that is set aside to pay your homeowner's insurance and real estate taxes. If you pay these costs directly, of course you wouldn't need to consider this issue. But if you don't pay these costs yourself, and these amounts aren't listed on your mortgage statement, call your mortgage company to find out what the monthly impound amount is. This amount is important because it affects your payment under any loan modification. Once you find out this amount, write it down. Once you calculate what your new payment might be with a loan modification, you must add this impound amount back into the payment to get a total payment amount. Now look at your mortgage statement for the principal balance. The principal balance on your loan statement is not accurate to the penny, but it's close enough for your purposes. If your mortgage company doesn't provide this information on your statement, call them to get it. This could take several days, and it'll feel like days of being on hold, so be patient. Once you know the principal balance, go to your mortgage amortization calculating software. Enter the amount of your principal balance in the category called loan amount or some similar description. Because most home mortgages are for 30 years, under the length or term of the loan, enter 30. If the calculator asks you to enter in the number of months, 30 years is 360 months. The next category is the rate of interest. Here is where you'll want to experiment. Although sometimes lenders offer a rate less than 2.5%, 2.5% is approximately half of the market rate. This rate would be a good way to tell how much your payment might be with a best case result. That is, a case in which your lender is really willing to help you out, but it can still make a profit from you down the road. Enter 2.5% as 0.025. The mortgage amortization calculator may ask you to enter in the month you start payment, usually a number from 1 to 12, and may ask you for the year that the payment is to start. For the purpose of obtaining a payment amount, enter in the number for the month after the current month. So if it's August, enter 9, representing the month of September. Bam! Just like that, the mortgage calculator gives you a monthly payment amount. Write that number down. Add back your impound amount to the monthly payment result from the mortgage calculator. This total is a ballpark amount of what your monthly mortgage payment might be with a loan modification if your lender decides to reduce your interest down to 2.5%. Please remember that 2.5% interest is an ideal or best case result, and often is just a dream number. You should consider yourself very lucky indeed if you could get a payment as low as 2.5%. You may want to experiment with other interest rates to see how your payments could differ depending on the rate you are offered. This mortgage amortization method assumes you're beginning your month from day one for the next 30 years. But you didn't just buy your house, and you've been paying on your mortgage for some time.